Hey guys, this is Justin from BreakingTheCRE.com, and in today's video, we're going to talk about depreciation in real estate. So if you're trying to understand how depreciation actually works in real estate investing and what the details of depreciation are, definitely stick around for this video. Now, if you're new here, on this channel, we talk about real estate investing careers and real estate deal analysis and financial modeling. So if you haven't already, make sure to subscribe to the channel and hit the notification bell to be notified every time we release a new video. Now, real estate is one of the most tax-advantaged investment vehicles out there, and that is for good reason. So governments tend to structure tax codes to incentivize certain behaviors, and private real estate ownership is one of those behaviors that they want to incentivize. And depreciation is a huge part of that and allows investors to take advantage of some serious tax benefits in real estate investing. So by the end of this video, you'll know what depreciation is, what the different kinds are, and how you can apply it to your next real estate deal. So let's start by first defining what depreciation actually is. So depreciation is defined by the IRS as a capital expense that is the mechanism for recovering your costs in an income-producing property and must be taken over the expected life of the property. Now, the way this works in practice is sometimes referred to as a phantom expense, meaning that even though you won't actually pay cash out of pocket in order to pay for this expense, at the end of the year, you're going to be able to deduct depreciation expense from your total taxable income. Now, the way this is structured for many real estate investors, especially if they put debt on the property, oftentimes depreciation expense can shield any sort of taxable income that you may otherwise have generated from a real estate investment. So with that all said, what are the details of depreciation and how does this actually work? Well, the first thing to know as a real estate investor is you're only able to depreciate the improvements on the land of the property that you own. So over time, a building and its contents may depreciate. There may be wear and tear on that building and its contents and the improvements on the land, but the land isn't going to depreciate over time, and oftentimes that land is actually going to appreciate. So you can only take depreciation expense based on the value allocated to the improvements on that land. So now that you know what to depreciate, how do you know the appropriate amount that you need to depreciate each and every year? Well, for commercial real estate, so anything outside of multifamily properties, the general recovery period is 39 years. So essentially what this means is you'll take 1/39 or about 2.6% of the value of the improvements and add that as a depreciation expense on your property every year. Now for residential rental properties, so anything from 1 to 4 units and also 5 and more units, that's going to be depreciated over a 27.5-year schedule. So since there may often be more wear and tear on a residential property, you're able to depreciate about 3.6% of the improvements on that land every year. Now all of this assumes that you use straight line depreciation, which applies that same depreciation expense every single year. But there are two main ways that this is going to be modified, and the first way is through a cost segregation analysis. So when you buy a piece of income producing property, you're not just purchasing the building and the land, but you're also buying improvements to the land and contents within that building. So as far as improvements to the land, this may be things like fencing, carports, lighting, or other equipment that may be on that land. And inside the building, you might be buying things like appliances, window coverings, floor coverings, and even things like the wiring of the building. So while it may take 39 or 27.5 years to depreciate the actual building structure, land improvements can be depreciated over a shorter time window of 15 years, and building contents can generally be depreciated over a 5 to 7 year time frame. Now what this means for real estate investors is that they're able to benefit from a much bigger depreciation deduction in the first few years of ownership. And oftentimes, if you only plan to own a property for 5 or 7 years, this can be a huge tax benefit for a real estate investor. Now, to do this, you'll need to do what's called a cost segregation study. And as part of that, you'll need to hire a team of CPAs and engineers, but oftentimes the tax savings from doing this can offset the cost of this completely. Now, the second thing that can change this is the new bonus depreciation rule that was enacted through the Tax Cuts and Jobs Act of 2017. And what this does is it essentially allows investors to depreciate up to 100% of qualifying real property expenditures in the first year of ownership. Now, these qualifying real property expenditures include anything with a useful life of under 20 years. So those land improvements that we talked about with a 15-year lifespan and the building contents that we talked about with a 5 to 7 year lifespan can now be depreciated 100% in that first year. Now, if this sounds too good to be true, it is, and here's why. When you go to sell a property, you're going to have to pay what's called depreciation recapture tax. And the current tax rate for depreciation recapture is 25%, meaning that all of the depreciation that you took during your entire ownership period, you'll have to pay 25% of that back in taxes when you go to sell the deal. That said, you may be able to defer this through a 1031 exchange, but it's still something to be aware of when you're taking depreciation expenses to make sure that you know what you're getting yourself into on the back end. So at the end of the day, depreciation can be a huge tax benefit for real estate investors, and with the right team of accountants and engineers on your side, depreciation can be a huge benefit to you as a real estate investor. Now, if you want to learn more about how depreciation is actually going to affect your real estate cash flows, check out my course, Commercial Real Estate Investing 101. We'll go over all about after-tax cash flow analysis and how to actually run that in a commercial real estate deal. And if you want to go deeper into all of this and get access to all of my courses, all of my models, and some additional one-on-one support, make sure to check out Break Into CRE Academy, and I'll link that in the description as well. So thanks so much for watching. If you like this video and want to see more content like this, make sure to hit that like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.